Okay, let's begin, guys. This is a special webinar. In this webinar, the topic is how to trade the coronavirus-led markets. So I want to sort of give you some indication how you should manage yourself during this type of market volatility based around a pandemic. And then I'll give you some strategies that you can, or the setups that you can look into during this time of uncertainty and a lot of momentum moves taking place from highs to lows, from extreme cases to significant weakness. Okay, and then we can sort of discuss the assets that could come in line with the setups that I've been discussing about. Okay, let's start off saying, as you can probably see, I am trading from home. So I am in my office. I have my trading setup on this side. I've got a setup over here, which is my sort of PC setup over here for, just reporting, documentations, simple Google searches, emails, and things like this. Whereas my setup over there is just purely for trading. I also have a large screen just for Bloomberg or wherever it might be. Have a good setup. That's your foundations, guys. Have a good setup. Make sure I've asked some of you guys to send in what is your home trading setup. Okay, so send in that picture of you in front of your home trading setup. Let's do that, guys. So the first thing I'll probably suggest is that you need to trade infrequently. It's important to remember to trade infrequently, right? Because we have a volatile market, right? We have a volatile market, and if I just remove this now, we no longer need this. And the first thing I'm going to bring up is the volatility index. That's the first thing that you should be monitoring, guys. So I go to currency, go to the VIX, remove the pivot, and really sort of, zoom into sort of the daily time frame. Have a look at this, okay? So I'm looking back from 2012. From 2012, you can see how the volatility index remained on average around the 20 figure, maybe even the 15, 12, what was it? 12.7 to be precise. That's the average. That's every time you sort of test this low and you see a bit of volatility coming into the markets. Look at where we are now. Look at where we are now. You saw a great amount of volatility coming in to play, and that's around the coronavirus pandemic. During volatile periods such as this, you've got to be cautious. You've got to be caution. You've got to have caution in your trading. How can we apply caution in our trading? One, trade infrequently. Okay, so find the periods where the market's moving often and the periods where it's quiet. Stay away from. Okay, wait for more confirmation to your trades. Yeah, add more confidences to your trade setups before you enter those setups. Okay, so trade infrequently around this volatile period. So wait for additional confirmation to your signals. Trade when there's a great amount of momentum taking place. That could be around market opens or when there's breaking news being released. And something else to also mention, which is extremely important, is that trade small. So trade infrequently and trade small. When there's volatility in play, why do you need to take the same amount of risk as you did previously for a smaller, a much larger move, right? So ideally what you want to do is, previously you were taking a position, you was aiming for a 2-to-1, and you're risking, say, $100 per trade, and you're aiming for a target of $200. Now, you could reduce that by half. You could reduce that by, say, $50. You can aim for a 4-to-1 and make the same $200. So reduce the risk and trade infrequently. That's how simple it is. So I don't want you to completely stop trading and not trade during this period. You've got to take advantage of it. So trade less and wait for more confirmed setups, but also reduce your risk. That is the most crucial part to trading. Reduce the risk. Okay. Now that we discussed volatility and sort of the increase in volatility that we've seen over here, especially since 2012, and we talked about the way to look for those setups and how to sort of trade those setups, okay, based around trading infrequently, trading small, waiting for additional confirmation, what setups do you want to apply? What setups do you want to apply? Okay, so I'm going to go through a couple of setups. What I'll do first of all is probably just, let me see if I can just try to, just move out the way. Come to blank screen over here. Right. So the first thing I want to do is discuss the there's three setups that I have in play. There's three main setups that I have in play, and I'm going to cover each one, okay? And I think the first one is, I'll probably this is band trading, okay? Apologies for my sort of writing. It's a little bit difficult using sort of one of these online sort of e-pens, okay? Band trading. Okay, so that's what I want to cover. The first one is band trading. Okay, the second is what I call is the dead cat bounce. You often hear me do these recent webinars. Yeah, so the dead cat bounce. Okay, you're often hearing this term on a regular basis from me because I love trading the dead cat bounce. Okay. And C is, of course, the relative strength. Relative strength. Those are the three setups you need to have in play, or the three strategies you must know very, very well. Okay, so I'm going to go through each one of these. I will go through each one of these independently, and then to finish it off, I'm going to cover some of the assets for each of these plays. Okay, for each of these trading setups. Okay, so let me start with A. What is that sort of A setup? Our, number one setup that we're going to be looking for is the rubber band, not rubber band, but more of like band trading setup. Okay, so indicators to use. You could use Bollinger Bands, you can use EMAs. Okay, so the indicator you want to use is either Bollinger Bands or you want to use EMAs. Okay, so moving averages, whether it's simple moving average, exponential moving average, even the weighted moving average that you want to apply, okay, depending on what you're used to. Or Bollinger Bands. Bollinger Bands are great, right? So they include the volatility of the market using standard deviation, okay, and the most recent price action. So those are the two indicators you could be looking to use, and this is what the setup looks like. So if I just let me just delete this. This is what the setup looks like. So what we're going to look for is a momentous move, a strong, powerful move in one direction that you've already missed. You can't take because you don't know where the floor is. You don't have a target that you can set where it meets your reward to risk ratio. You've missed the trade. You're just watching a market just go in one direction, and it's got to be a significantly aggressive move in that direction. Okay, so in this type of market, you're expecting a move to be down, a significant aggressive down move. Okay, so what we're going to look for is markets just selling off. Markets, just selling off, and then you see a strong amount of selling pressure coming into play. And you have that band there. You see the band there. Okay, whether it's an exponential moving average, whether it's a Bollinger Band, you see price breaking below or at the band and breaking through the band frequently. Okay, and what you're looking for is when it meets the floor and you start to see some indecision candles being formed. Okay, you see the indecision candles being formed. Okay, what you're looking for in this sort of band trading setup is price. You want the candlestick and price to show some indecision candle. Okay, so what you want to see is the first move is a strong, powerful move in one direction. You want to see a strong, powerful move in one direction. Then you want to see almost price holding a low, holding a round number, whatever it might be, showing some indecision in this region here. Okay, that's your second part to that setup. The third is a strong, in this case, bullish close above the moving average and above the most recent indecision candles. Okay, so you're looking for that strong bullish candle, something like this, that closes in this region here. That's the sort of close over there, and that is your entry point. That is your entry point. Okay, so that's your third part. That's the third part to this setup. Okay, so let's go through that again. The first part of this setup is price breaking through the band or through your moving average, or testing the lows of that lower band and continuing lower in one momentous move, one strong, powerful move. Okay. Second part to it is price starts to stall, doesn't have the same aggressive selling pressure, consolidating, showing some sort of price pattern, showing indecision candles being formed, large wicks, small bodies, or small wicks and small bodies. Okay, those are type of indecision candles. The third part to this is a strong reversal candle, a strong bullish candle. It could be bullish engulfing. It could be a Marabuzu type of candle, okay, that closes above the most recent indecision candle lows and highs in this case, but also breaks through your band, whatever it might be. It might be a Bollinger Band or the moving average, okay, and that is your entry point. So that's the setup. That is your setup. Now going to the next part to this band trading strategy is that how much of a pullback. So remember, the one thing I want to say is that when you see markets selling off like this, okay, and it hits a floor, yep, we've got our floor, it's hit our support region, and we're starting to see markets start to push a little bit higher from this point over here, okay. Now, how far back will it pull back? How far will it pull back is the question, okay. Now, what most traders end up doing is expecting that price just completely reverses the whole thing, right? And that's what the markets. If you look at Bloomberg now, what is Bloomberg talking about? It's saying, you know, we've seen the most recent rally taking place. Is this a V-shaped formation? We're going to see this taking place, or is this a bear trap? A bull trap where we're expecting, you know, bulls to step in all of a sudden, expecting that big sort of, you know, move to take place, and then you have the large amount of institutional short sellers stepping in and really driving the market lower, known as the dead cat bounce, right? That is the question here. That is why it's important with this setup. Don't expect this move. Don't expect this. This is not what we're looking for. That is not what we're targeting. You are short-term intraday traders, okay? Your focus should be the short-term move, not the trade that takes you from Earth to the moon, okay? So don't expect that large move to take place, right? So if I just can shift back slightly, let's go back. Right. Now, it's often you're going to see markets, once it meets that floor, and that's where a lot of profit's been taken and some of the buyers are stepping in this case, is that you start to see a pullback taking place, okay? And the pullback may take place, I don't know, you could take a certain fib level. If you take a fib level, it retraces by 38.2%, okay? That is seen as a pullback. That's your pullback. I would say that happens the majority of the time. 70% of the time, that is what takes place. You have just a pullback, okay? We're using the fib in this case, 38.2%, even 23.6% of a retracement. Not retracement, sorry, pullback. Yep. In some cases, it may go a little bit further. In some cases, it may pull back, say, to this region here, which we can say on the fib level, if I can take that. Fib level is this 50% or the 61.8% level. Now this happens, I would say 30 to 40%, not 30, 40 to 50% of the time. 40 to 50% of the time that may happen. Yep. But this to happen, it comes all the way back, does a full reversal. If you take the fib, it's gone back to 0 again. From 0 to 100, it's gone back to 0 again. It's done a full reversal. This happens, I'll say 20% of the time, okay? 20% of the time, even if that. Yeah. So what I'm trying to put into your mindset as a trader is don't look for those V reversals. Yep. Okay. Most of the time, this is going to happen. Most of the time, this will happen. A small pullback. Sometimes this may happen, okay? Sometimes it may do a larger correction. Rarely it's going to do a reversal. Rarely is it going to do a full reversal. So expect a pullback, expect a correction or retracement. Rarely expect a full V reversal, okay? Hopefully you're still with me and you understand what I'm trying to say there. So the point being with this setup is the next stage is, right, look for the pullback, right? Define that region, whether you take the fib, you look at a pivot level, you've seen a higher period moving average or exponential moving average being here, let's say that, right? So a higher period moving average being, look for the sort of target to be back to sort of meet this point, correction up to this point, so price comes up to this point, and then you start to see a little bit indecision candles, looking for that reversal lower. Okay, so your goal is to enter sort of in this region, target over here, stop loss in this region, and that's how you make these short-term moves. Yep. On the pullbacks, or in some cases it could be the correction. In rare cases, you could be lucky enough to get in on a full reversal. Yep. Hopefully that makes sense. That is your band trading, guys. That's a simple band trading strategy that will work, and it's worked for me in the most recent days, trading around the coronavirus. Now let's move on to B. B is the dead cat bounce, as I quite often talk about. Okay, so B, right? So we're going to talk about the dead cat bounce. Now, what I like about A and B is the fact that both, it's almost that you could trade them back to back on the same asset. Okay, so we spoke about that initial sort of, move lower, right? You have a move lower, you have the band there, and price consolidates, right? And then you have that large push higher, and that's your entry, right? And that's your band trading, right? But the next step is we're going to look for that reversal. We're going to look for whether it comes back to the pullback region or it comes back to that corrective region. That's where we're looking for that dead cat bounce reversal to take place. Okay, that's when we're looking for that dead cat bounce reversal to take place. Okay, so let's assume that we applied a fib. We applied a fib from sort of that high down to these lows, and it's showing me sort of the 38 being there, the 50 being there, the 61.8 being there. Okay, those are fib levels, yeah. So it's 61.8, 50%. Again, apologies for sort of the handwriting there. It's a little bit awkward. 30.2. Okay, that's our fib levels, yeah. So what would I be looking for in a dead cat bounce move? Well, you're going to see a large amount of push coming through as soon as it breaks through the moving average, right? That sort of the band trading strategy is now in play. It's coming up to a key level, and that's where you want to start to see weakness as it approaches. Let's assume that it breaks through the 38.2 very quickly, and then we start to see price sort of, weaken as it comes to the 50% level. We see weakness in the move. So these initial candles here were strong bullish candles. And then we've seen this most recent price action. We're seeing weakness as it approaches the 50% fib level, and some indecision candles being formed here. Okay, so that's 2, and that's the third indication. Okay, so this is now defining that price is neutral here. Okay, buyers and sellers are neutral, waiting for new information to step in, waiting for either buyers and sellers to take control. That's what we're looking for. So the setup in this case is you're waiting for a strong impulsive candle that breaks through a significant low. Now you could wait for this low, the rejection. You can almost get in at the top. You're sort of anticipating that top, take entry here. One of the benefits here is if you take this trade, your stop loss goes up here, and your take profit is back to these lows here. You get a great reward to risk. That's the A setup in regards to the B trading strategy. Okay, the B trading strategy is dead cat bounce. Part of it is you've got 2 entry points. You can either take a very aggressive entry point at this region here, or we can wait for price to break through this level, break through the 38.2, enter in this region, entry here, stop loss above the high, and then take profit here, which reward to risk is less. Still gives me, you could say, a 1-to-1 reward to risk, but it's more confirmed. You have more confirmation, right? It's always that trade-off. There is always that trade-off between how much confirmation you need and does it meet your reward to risk ratio, achieving your reward to risk ratio. Okay, and that will be your sort of dead cat bounce situation. That is your dead cat bounce entry points. Now, those are your A setups and B setups. Yeah, A setup being the band trading strategy, B being the dead cat bounce strategy. Okay, so this is what I'll be looking to apply regularly. This is what I'm looking for in the markets. This is what I'm looking for in the market. The third setup, which is C, as I mentioned, relative strength. Relative strength. Now, what is relative strength? You should all know what relative strength is, especially that we do, currency strength. Yeah, so often we're doing currency strength on a regular basis. What we're defining with relative strength is momentum. This is momentum trading. Momentum trading. There's greater amount of volatility in the market. You can really take advantage and take lots of momentum trades. Go in when there's so strong, strong emphasized moves that takes place, whether it's a specific news related, or it's the opening of a session, or it could be just a random breakout from a technical perspective. You've got to look for what works best. Okay, so you're trading momentum. Yep, momentum meaning is you're looking for bounces, breakouts, bounces, breakouts. Those are the things that you're looking for. Meaning that, you assume price action is done this, pulls back, does this, pulls back, stuff like that. Okay. Right. So just assume that I can put a clean trend line here. Shall I see if I can put a clean trend line here? Maybe. Nice. Okay, we've got a clean trend line in place. Okay. Back to my pen. Right. So this is what I'm seeing here. I'm seeing price. I've got an uptrend line, and let me put in another sort of level. Let's see, horizontal rate just above these eyes. Let's say that there. Nice. Okay. Right. So these are your two setups when you're looking for momentum trades, right? You're looking for either the bounce or the breakout. The bounce meaning that if you got 1, 2, and it comes back to a third touch, you enter here. So you enter once it sort of consolidates here, bounces off the moving average. It could be a moving average, or it could be a trend line that you apply. Okay, that's your entry point. That's your sort of your first entry point or your first setup using the momentum and relative strength, right? I'll go into sort of the assets that you should be looking for in regards to around this, right? But this is what you should be looking for: is either either for the bounce or the breakout when you're trading momentum. So that could be your first or your type of setup that you're looking for. The benefit with this is you have very tight stop loss. So if you're wrong, quickly. I'm out. Okay, this ain't work for me. Okay, let me look for another setup. Very quickly when you're wrong. Okay, reward to risk is much greater. Reward to risk is much greater. But the key here is your technical's got to be on point. Your candlestick analysis has to be, on point also. Yeah. The second setup is on the breakout. So when price does that, that's your sort of second entry point. Okay, now you're going to have a wider stop loss. You're going to have a wider stop loss, but the fact that it's broken through these significant highs, and there's volatility and momentum, volume is going to really support this, and you're going to see not just a small move taking place, you can see a very large move taking place. The reward to risk should match itself. Okay, and that is your relative strength trading, right? Trading technicals, trading strong against the weak. That's what you're looking to do here. Trade momentum. Okay, and so what do I need to do? Just give me a second, guys, while I just adjust this. Okay, right. So the assets that you should be looking to trade, okay? So, there are two different types of assets that you should be focusing on, and it's important you understand, which assets would move in which, with which setup is what I'm referring to. Okay. Now I'm going to be looking at what are your assets, what assets to trade. Yeah. For your A and B setups. Yeah. So your A setup was the band trading strategy. Yeah. Remember, only looking for the pullback, the correction move, not always looking for that reversal. And your B being sort of the dead cat bounce, right? So when it does pull back or correct, is there another opportunity to take it in line with a major trend, go in short, dead cat bounce move. Yeah. So what are the assets in regards to sort of A and B? And then we have our C setup, which is using momentum, right? Using those relative strength understanding of relative strength and applying it to the currency market, for example, looking at what the strongest currency is, apply it with the weakest currency, you know there's going to be volume there, you know, and just look for those breakouts or the bounces. Looking for the breakouts or the bounces is key. So now, what are these assets? So what are these assets? So let's start with, you know, your panic selling assets. And when I mean, you know, panic selling assets, what is those? How do you know there's panic selling in the markets? How do you know there's panic selling in the markets, right? Sorry, let me just go back to this. How do you know there's panic selling in the markets? It's when you hear noises like this. It's when you hear noises like this. Sell, sell, sell. The markets are going down. So when you hear Bloomberg calling that, and you see markets opening, and you're seeing a large amount of sort of, you know, selling pressure in the market taking place, huge percentage changes, you know, circuit breakers, trading halted, all these terminologies are defining that there's going to be an A or B setup. There's going to be an A or B setup, and that's what you should be looking for, okay? And those A and B setups, who's going to hit it? Who's going to be hit most? Well, naturally, it's going to be stocks. Stocks are going to be smashed on this, right? Stocks are going to go down much lower. Okay, I'll be looking at emerging market currencies, or you could be looking at commodity-based currencies. Okay, we're seeing a huge systemic sell-off when this happens. Okay, you know, whatever stimulus package that the government put into place, or whatever monetary stance that the central banks are defining, it's not having an impact. It has had an impact since yesterday, but that could be very short-lived. So you're looking at emerging market currencies and commodity-based currencies. That will be your Aussie, your Kiwi, your Canadian dollar. Okay, your euro and sterling could be weak because euro is massively associated with Italy, Spain, Germany, and we're seeing huge numbers of you know, coronavirus cases being confirmed there. So those are the assets that you should be looking at: the stock market, emerging market sort of currencies, commodity-based currencies, or any currency that's majorly impacted by the large spike in coronavirus cases. I'm just looking to those numbers now. We're at 423,000 confirmed cases. Okay, so that's your sort of the assets that I'll be looking for. Now, what about the C setups? And your C setup is trading strength with weak, right? And I'm trading it in one direction only. I'm trading it in line with what's taking place in the markets, right? And you know, this is in my sort of, you know, it's now coined this term. I'm not sure if you guys heard it. This might be a little bit insensitive, but I'm going to go ahead and do it anyway. It's Corona time.
Hey, it's Corona time right now.
So this is going around on, you know, TikTok, and you know, if you're optimistic, guys, if you're optimistic about trading, whether it's pessimistic about the coronavirus, it doesn't matter. Put them two separate things to the side, okay? So have that optimistic view. Okay, in a market like this, with coronavirus systemically impacting all asset classes, there should be some assets outperforming, some assets doing well. Now, what can we talk about? Safe havens. Come on, guys, you should know this. Safe havens, right? What is that? Gold. Gold should be doing well, okay? Silver should be doing well, right? As they say, cash is king, and we've seen that in the dollar index rising above the 100 handle and going up to 103 at the highest. So the dollar index, have a look at the dollar index, okay? In some cases, the yen, the Swissy, those are sort of the assets that you could be looking at for that opportunity to go long using sort of the coronavirus relative strength plays, okay? Looking for the strong versus the weak in those times. Other areas in regards to stocks, if I look at stocks, is which assets have been doing well. Now, you know, 2018, 2019, we started to see a growing trend of remote working or home working at home. In 2020, this is almost mandatory. How many people are working from home like I am right now? They're going to be using, for example, GoToMeeting as what I'm using now, right? They're going to be using Zoom. They're going to be using, you know, Skype. You know, these types of stocks may do really well. Netflix, right? I've just subscribed to Netflix because, you know, I'm going to be spending more time at home. And so is the missus, and therefore she wants, you know, we want to watch Netflix more often. Okay, so those are the areas that you need to look at when you're sort of defining these coronavirus, plays. And that's it, guys. That's it. That sort of is the market breakdown on how to trade coronavirus-led markets. Thank you for joining, and I will see you soon.